Hi, everyone. My name is Jacob. I'm a partner at Superscrypt. We're an early-stage crypto-native fund based out of Singapore. We invest mostly in infrastructure and technology. But enough about me. Today, we are here to talk about DeFi, and we've got two specialists on stage with us. We've got Andrey, we've got Dan. I'm going to throw to you guys to introduce yourselves and maybe a little bit about the portfolio companies or the companies that you work for.
Thanks so much. Hi everyone, I'm Andrey. I'm founder of OPIUM protocol, and that's decentralized derivatives on chain, on Ethereum chain. I used to manage a hedge fund, and I was in redefine for most of my life. And now I'm very excited to do DeFi.
Hi everyone, thanks for coming down. My name is Dan Thomson. I'm the CMO InsurAce, which is the leading DeFi insurance protocol, which is the sexiest protocol in DeFi at the moment. We provide on-chain insurance for smart contract risks, stablecoin DPEG risks, custodian risks, and bridge transaction risks.
All right, so let me set the scene before we jump into some of the questions, right, of where we are today with DeFi. Last year, in 2022, we had $3.8 billion of losses from smart contract hacks, exploits, protocol problems, right? And this year, in 2023, it hasn't really slowed down either. We've lost $700 million. Euler Finance is a very secure protocol. That suffered a hack. We saw the Curve attack with $69 million of liquidity drained. So I'd love to hear from you guys what your thoughts are on the state of DeFi and how sustainable it is for these protocols to operate in this environment.
Thanks for the good question. I think DeFi is at the very beginning, and to say simple, what we need some complex instruments, derivatives, insurance, to make it more mature. And a very easy example, like if you have a car, you can protect it, talking about hacks. You can protect your car, you can put all kinds of alarm systems, you can put anything you want there, but it can be still stolen. Another approach is to buy an insurance, and then you can sleep well, and it's a financial solution for the problem. And I can make much more examples, but that's basically what we need in DeFi. In order to be more mature, we need different instruments to share the risk, to transfer the risk, and so on. So insurance and derivatives are those instruments, and we are working on it hard. I hope to see it more.
Awesome.
Yeah, I mean, I think that 3.8 billion out of DeFi hacked last year, and I think it's around 12 billion out of the wider crypto market. Hacked, exploited, stolen, phished, whatever it is. You know, you're talking about around about 1 to 2% of the total. I mean, obviously DeFi TVL is right down right now. So at the time it would be about 1%. If you look at it about now, it's probably up around like 4% of that total amount that's actually staked into and locked into these protocols. You know, it's a huge amount, and 3.8 billion in itself is a huge amount for people not to be investing more into this. But I'm going to put a bit of a controversial twist on that and say that these hacks, as Andrey says, we are early. And because of that, I think that it's a necessary part of this evolution of what we're doing so that we can all improve. So that every builder here, everyone who's learning about the space, everyone who's wanting to get into the space, sees these mistakes, sees these hackers getting involved, and sees how they're taking the money. Hey, and maybe they go down that route. Maybe they say, do you know what? I fancy trying to steal 100 million myself. Who would, if you could? But the reality is, all it does is it forces every team who's in the space building for the right reasons to improve what they're doing, to learn from it, and make sure that that doesn't happen to them, because at the end of the day, their users are the ones who get hurt, and that hurts everyone for the future. People who get burnt on one particular protocol don't trust those founders again. And these founders are really working hard. We're all working hard to ensure that we're building something to make people's lives better for the future, to reimagine finance, to do a better job. So, yeah, if these are happening, and like I said, they are a necessary evil in my view, that we do improve, and it does make everything better for the long run.
Okay, so that's all well and good. We can accept hacks to some degree, because if we don't have them, we're not going to have great protocols. But how does that work for a protocol or a business like InsurAce? because you're going to have a bunch of risks, and you can't really cover all of them, or maybe you can. So could you maybe talk through some of the risks that users will face in DeFi and what you guys would be able to look after and what you can't?
Sure. So if crypto's, well, we all say crypto, we're still early in crypto, we're definitely early in DeFi. We are super early when it comes to insuring the risks that come with it. So there are not, even with insurance on a global scale in traditional finance, you can't cover everything. There are global catastrophe risks that only have something like 20%, actually covered, even though you take like natural disasters that happen all the time, all the data from history, and even then they're still not completely covered. The same thing happens in crypto and DeFi. A lot of the risks we just, you look at and there isn't either sufficient data or the risks are too high. So we look at things like, let's say slashing cover, you've got a few billion transactions and you can see how many times validators have been slashed. So you can understand the risk, and there is more data in the last few years of slashing than there has been in the last 2 decades of cybersecurity, because it's all on chain, it's all there, and it's all easy to see.
Wow, okay, so that to me is a really interesting factoid, because when I look at DeFi, I think it's a brand new world, right? So I think that a lot of the data is hard to get, but what we're seeing is that the on-chain paradigm means that you have more data points to be able to price risk, essentially.
Yeah, so then it just comes down to extracting those data points, being able to validate them, and then building those, and arguably traditional insurance models around that newly available data. And to actually, that allows us to, work out the price and the capacity for those particular risks that we're looking at.
Got it. Now, Andrey, how do we use derivatives to protect against risk? Insurance is one plank, I guess, of a defense mechanism, but how does it work for derivatives?
I think it's absolutely the same. The difference is that derivatives are more underlying instrument. It's like coding on assembler. Because insurance companies, they do use derivatives in order to hedge. And derivatives are very flexible instrument. The disadvantage for retail that it's very difficult to use. But under every insurance, there is derivatives for sure. And the cool thing about derivatives and pricing, that derivatives are priced, normally they're priced on the market. So it's supply demand. And if they are mispriced, then there are a bunch of hedge funds who are going to take advantage of it and put the price down, up or down to the fair value. But more or less, derivatives are like insurance. So CDS contract, it is insurance, but it's very difficult to trade CDS contract for the normal person because it is sophisticated. So I would say that it's very likely what we do is just different layer of abstraction.
Got it. And I think you said it yourself. It doesn't come naturally to retail users to be able to hop on a protocol, play around with derivatives. Even insurance sometimes doesn't seem all that intuitive for people to buy for DeFi protocols. So how are you guys going about educating people and ensuring that you onboard people to use these products to have a backup plan for their DeFi activities?
From our side, yeah, we try and integrate as much as possible. So if we were to integrate with OPIUM, it might be an add-on that when someone's trading and they're locking capital into the protocol, they might actually then have an option to add the insurance on top. One great example of this we've done recently is for our new bridge transaction cover. So we've just partnered with LeFi, who operate a bridge aggregator across the space. And so if you actually go to their native bridge, jumper.exchange, as you go through a bridging transaction, which does make a lot of people nervous, especially people who are new to the space and have heard about a lot of the risks that are associated with DeFi and bridging in particular, you now have this option to mitigate that risk completely by having an add-on for insurance, very similar to adding an opting in for flight insurance. So I'm guessing a lot of people have flown here for this week. So just as easy as adding flight insurance, you can now add bridge transaction cover by using jumper.exchange or any of the LeFi affiliated bridges.
And I do think we need more, let's say, regulation, or at least risk disclosures, because everybody is doing something, but it's very difficult to understand what is the risk behind it. And DeFi is complex. So the more complex the instrument become, the more disclosures they need. And we see some projects are doing self-assessment of risk. They do some standards which they follow, but we don't see it as in an industry level. I think this is, everybody hates regulation, everybody hates to speak about regulation, but I actually do like simple, reasonable regulation. So the problem with regulation is everything is over-regulated in traditional finance. You have hundreds of regulators, but some very simple, some very basic regulation does make sense, I think.
If only there was a standard that we could all abide to that says this risk assessment has been done to a good enough standard, and here's the score.
Or at least the standard, how you disclose and what you disclose.
Yeah, completely agree.
Yeah, I mean, if we had more standardized data, then we could probably run more actuarial models and have more deeper and better insurance products covering different risks. But maybe let's dive down into the risks that people face, right? Let's go in a little bit more detail. We've got smart contract risk. We've got market volatility risk when people trade. We have the team rugging, right, and leaving a project, risk around that. What does InsurAce or maybe even any other insurance protocol cover right now? Because as you said, it's really early, right? So what could you price and cover?
So at the moment, we're covering things like smart contract risk, stablecoin DPEGs, bridge transactions, slashing risks. You've got a few new upcoming different types of risks that are tied onto real-world assets. But there are lots that we still can't cover. You're right, rugging risks, market volatility, which can be hedged with derivatives. But rugging risk is one that is in demand, but there's not much that people can do about it. Same with things like custodian risks, especially after FTX last year. People are a lot more wary of where and how they store their crypto.
Got it. And so it sounds like you cover smart contract risk, bridging risks, but insofar as markets go up, markets go down, maybe derivatives are better suited for that.
Yeah, derivatives are definitely much more focused on the market risk, so you can hedge different market risks and create risks at the same time. Funny enough, we were just talking about it. We had insurance product for smart contracts a few years ago. It was like CDS contract on smart contract risk. And we did offer it to auditors. We contacted, I think, most of major auditors and saying, hey guys, you are making an audit of smart contract. Does it make sense that you sell insurance, so you underwrite? Because that will show some credibility, that you put some skin on the game. So yes, we audited, but we also put some money as skin on the game. Everybody said no. And that was funny. This is just an example about the maturity of the industry, how industry ready for this.
Isn't that crazy? The auditor's role is to ensure or give a guarantee that a smart contract has been looked over, that the code works, that there's not going to be any bugs, but they didn't want to put their money where their mouth was.
Yeah, we were surprised as well.
Do you know what? I've got a good one for that. It's because I think, and I know the hacking guys are here. I don't know if they're actually... they are here. So I probably got this stat wrong, but it's something like, I don't know, it was like 40% of people after an audit don't then upgrade their contracts or something ridiculously high. So even though they get the audits, the amount of teams that don't then make the suggested improvements, or at least all of them, is ridiculously high for what you'd think it would be. So that maybe that contributes to why they don't want to actually underwrite the risks.
Got it. So a little curveball question here, right? We always hear about the hottest trends in Web3, whether that's AI or some new restaking thing or liquid derivatives. But if we go back to AI, how do you think AI may or may not make what you guys do better, easier, or maybe even more difficult?
Well, that's a very good question. I think the AI can be nice to have tool, and I don't believe yet it's something going to be built on AI, because it can analyze information, it's a language model, it's pretty cool right now, yes. But if we put some money on it, if we trust money based on the result, I personally don't see it yet. I don't know. What do you think?
Personally, I'm a massive fan of AI, and everything and anything AI right now. Our team still will oversee what we're using AI for and how we can actually learn to improve what we do. But we have some big bottlenecks. Our risk assessments to list any new protocol take 3 to 4 weeks. So by having AI help us to do our own mini audits of code, to help it build out the better data models, which helps with products. So from across the board, even on just a marketing side, right? Marketing enabling us to communicate things and complex issues in an easier way or a different way through AI is one thing. Our product team are using AI to help with the calculations and just sheer data analysis from these different products that we have, and we have the data there. But instead of having our team having to crunch the data and our head of product having to oversee it, well, he still is overseeing it, obviously, but having the AI run the data side by side at the moment, and we will get there when it does get to a point where maybe the AI can do it all automatically. But even just for our risk assessments, it's like having another pair of eyes look over the code for us when we're doing a risk assessment.
But you're speaking about using AI for yourself, so the risk is on you. If AI doesn't deliver, then it's your problem. It's not the client's problem, right?
Sure.
I don't think it's going to be like ever that you make a product and AI going to decide something for the risks that the user takes. Because if something goes wrong, then users have a big problem.
I think there can be AI enabled from both sides. The users could use AI to verify the risk assessment pretty quickly. We can actually, there are plenty of people building risk assessment tools already using AI. So I think it just enables the whole space to better improve what they're putting out there, as well as that sort of safety standard we're talking about earlier. So if AI helps to alleviate some of the manpower that would have taken before, if it's set up in the right way, then we should all be all for it.
It's a completely different discussion, but it's very interesting, because if AI can help you to assess the risk, probably it can help you to go around and make something which optically looks like good risk, but it's not. So I mean, simply speaking, AI can also hack the system, right? If one AI is protecting the system, another AI can hack the system and make it look very nicely optically.
Of course, there's always going to be bad actors in the space, and maybe they leverage AI for their own malintent. And sure, that's going to be an ongoing battle of good and bad, and it has been in the financial world for forever. So I don't think there's an end victor. But as my earlier point was, I think that the bad actors do help us to build a better world for the good actors. And actually, relatively speaking, the bad actors in the space, when you really do boil it down, is actually such a small percentage of what the wealth generated has been in the space. I mean, that's why we're all here. It's why we're in a very, very nice setting in Seoul to have this conference and be able to talk at.
Well, maybe rather than AI being the main solution for insurance or for derivatives, you could just use it in a more simpler setting. So it doesn't have to decide something for the customers. But we touched on how education is really tough because these concepts are difficult. So imagine even having the right inputs or outputs that go into a LLM. So someone could say, okay, how do I hedge this risk? And an LLM could come up with an answer, either using your protocols or other insurance protocols, right?
That's exactly the usage, I think. That's exactly going to be the usage, because it's so sophisticated nowadays, and onboarding client abstraction, a lot of other problems can be solved by AI, that's for sure.
Got it.
Is your fund investing in something like this?
No, but thank you for giving me the idea. So that you never know where you get inspiration from, I suppose. So that's fantastic. All right, so it sounds like we're still very early. We're still early TM, as everyone always says. DeFi still has a lot of problems that it needs to solve. But what's a positive thing that you guys are looking forward to in, let's call it, the next 12 to 24 months? As we march on?
Plenty. I think that there's still a lot to be looking forward to. There's some great teams building in the space. Personally, I was really enjoying a lot of the GameFi talks earlier. I think someone was mentioning about how it's still that early stage of adoption and getting there. But ever since GameFi sort of came along a couple of years ago, I've been massively behind the idea of like owning your own assets. And I know that's not. Sorry, I know we're getting away from DeFi. How did that happen? No, in DeFi, like we're actually about to, and this is a Korea Blockchain Week exclusive for you guys. We're actually about to launch this concept of RiskFi, which actually allows people to invest into the underwriting of different risks in the same way that insurance companies make their money in the traditional world. This RiskFi concept basically allows people to not only get their standard yield, but fully protected with some standardized risk assessments on different yield strategies, whether that's low, medium, or high risk, as well as taking opportunities from the money making behind that actual risk underwriting business. So that's something that we're super excited about in the next 6 months, let alone 12, 24.
Yeah, that's actually, I share this. And the thing that every return has a risk. So people, not everybody understand that for every return you have a risk. And the higher return, normally the higher the risk you have. But we all have different views on risks. We all have different perspective on risk. And risk tranching, so it's a very good and strong instrument which will make DeFi just much more mature. Personally, I'm also very excited about derivatives because, of course, I'm biased. I do derivatives. But look, first of all, it was spot market, centralized spot market like Coinbase, and then Uniswap took a big part of it because it's faster, more secure, more flexible, so on and so on. Now we have the same situation with derivatives. There is roughly one player, Deribit, who takes centralized market, and it has grown enough. It's quite big already, and it's time now for decentralized derivatives like Uniswap for derivatives. So that's my biggest expectation. But I do think about regulation, risk, disclosures, user education, account abstraction as well, because that's needed for everyone, not for DeFi, but for all the blockchain.
Well, yeah, I think when you look at the traditional markets, spot is literally a tiny spot on the map when you compare it to the volume that derivatives do, right? And so if you take that concept in the real world and apply it to DeFi, then there's actually quite a lot to look forward to in terms of the potential growth of derivatives in crypto and Web3.
Yeah. So that's another idea where to invest.
Well, I'm getting more ideas on where to invest, and yeah, that's fantastic.
How do you onboard the next, I don't know, million users for derivatives and DeFi?
Actually, not sure that retail users going to use derivatives because derivatives is it's the biggest market in the world. So derivative market, global derivative market right now is probably 10, 20 times bigger than the world GDP. But how many of us do trade derivatives? Only professionals, right? However, everybody has exposure to derivatives. If you have a bank account, if you have insurance, if you have mortgage, you do have derivatives without knowing it. So I think it's going to be kind of the same. I don't think it's going to be a challenge to bring 1 million users, but it's a challenge to bring 1 million professional market makers, companies, so on, who will use derivatives. And end user, they will have exposure to derivative market through guys like you, so through insurance, because everybody understands insurance, so I can go and buy insurance, which is hedged by derivatives. But I do think derivatives is a little bit more professional product, and we see a lot of retail going into it, but it's not going to be massive.
Sorry, this is where we get a bit away from our main topic, but do you see many new strategies that are sort of DeFi exclusive relative to traditional finance when it comes to derivatives?
Absolutely, absolutely. So basically, everybody can run a hedge fund right now. So it used to be like the privilege, and you need to work like 20 years, and I was dreaming for 15 years of my career to work in a hedge fund, and I was leading one hedge fund. But nowadays, you just need to be educated, go and use strategies, and strategies can be very simple. Market making, providing liquidity to Uniswap or something like that, providing liquidity not in a market neutral way, but directional way. That's another strategy. So basically, you define the risk, and there is a strategy for it, which you can do yourself without any custody, without any intermediary, also not paying huge amount of profits to those intermediaries. That's amazing.
I guess I'll be down the VC brunch tomorrow raising for my new hedge fund that's going to be DeFi native. Jacob, you coming in?
Yeah, you know, let's have a chat. Let's have a chat.
Or maybe you're a little bit too late, but who knows?
Well, maybe there's a combination of your products, right? I mean, if you think about, everyone talks about diversifying their portfolio. Well, what about diversifying your defense mechanisms? I think there's a place for both products.
I think there's definitely, yeah, of course there is. I mean, the combined option would be, the risk strategies that we employed in traditional derivatives markets, plus those added risks of DeFi, so like smart contract risk, possibly stablecoin depegging risk when they're actually deposited into the protocol itself, amongst some others. But this actually ties into what we're trying to build with this whole new risk-fi narrative in terms of taking these protocols that are leaders in their industry, within their niches within DeFi, and making sure that the risk assessments are done properly on them and public, as we're talking about before, and then being able to make sure that they're secure with things like insurance or certain bug bounties or certain assurances that the end user, at the end of the day, will not get hurt by using the protocol outside of their own mistakes.
No insurance covering that one.
I don't think anyone's going to cover that one anytime soon.
What do you think is going to be the most popular, biggest, or most sexy product, insurance product in a few years' time?
In a few years' time, I mean, hopefully there's a bull market again, and then the yields will come back up, and suddenly the cost of insurance becomes a lot lower, which makes it all a lot more appealing again. So, our previous example was, and our biggest product and payout ever was on UST last year, but that was when people could stake their UST into Terra, into Anchor on Terra, get their 20%, 19%, 20%, come to us for 2.5%, plus a UST stablecoin depeg risk of 1.5%, and so they're still netting 16% completely safely, which in today's market sounds unbelievable, and I think more people should have realized that it was unbelievable back then, but here we are. Which led us to end up paying out 12 million to users. It was a great use case for us, and it was by far our biggest product. And it was a great way to show that DeFi insurance can and does work. And I think that will come back again. And I think as the data improves and as our models improve, that cost of insurance will go down, which will allow us, even during a bear market, to cover those risks. But even now, there are protocols that are still yielding quite highly. I mean, we're still super popular with things like GMX and Perpetual, high-yielding protocols right now. So, yeah, it's still there. It's just market conditions and also just getting that right product fit is super important.
Yeah, and coming back to your also previous question, the biggest advantage of DeFi is composability, actually. People not always think about it, but that's a perfect example how you can reuse or take few risks at the same time on the same capital. And that's definitely an advantage. That's definitely the way that our protocols can work together. And what do you say that you add one yield on top of another? That's actually amazing because that brings diversification and better Sharpe ratio. So Sharpe ratio is risk-return ratio, so it improves dramatically once you have this composability, once you combine different uncorrelated risk in one basket, and that was a perfect example.
Yeah, so I mean, users might lose a percentage point here or there, maybe two, but at the end of the day, if you're completely mitigating those risks of using the protocol, then that comes down to your own risk tolerance. But we're seeing more sophisticated investors are the ones who are picking up on the insurance risk and understanding that that is an important part of what they're doing, and actually understanding that the risk is there, and usually they're managing someone else's money, right? So that's usually where they have to be extra careful.
Amazing. Well, that's the promise of Web3 infrastructure, right? Composability, having solutions like this that could potentially be built on top of one another or in tandem with one another. So there you have it, guys. When you consider DeFi, think about insurance, think about derivatives. They might not be top of mind, they might not be immediately sexy, but when you combine the both of them, they really are.
Super sexy.
There we go.
Absolutely.
Super sexy.
Well, it's not the most exciting thing because people normally excited by 1 million % APR, and you know how that's going to end up. But thinking about risk is very important in the long run.
Definitely. Well, thank you, guys. I would love for you to give a big applause to Andrey and Dan for their time today.
Thank you.
Thank you so much.
Thank you.